Usually we start these deep dives by looking at the headlines. Who's angry, who's speaking at the UN.
Right, the political theater of the moment.
Exactly. But given what's unfolding this weekend, we're going to do something a little different today.
Yeah, we're turning off the rhetoric.
We are. We're ignoring the press conferences, and we are strictly looking at the machinery.
I like to think of this as a structural economics session. Think of it less like the evening news and more like, well, a masterclass in how the money actually moves through the system.
Right.
Because when you strip away the politics, there's a very specific mechanical logic to what is happening right now.
It's Saturday, February 28, 2026. The world is obviously chaotic right now, but our goal for you today isn't to speculate on motives or point fingers.
No.
We are here to look at the ledger. And I want to start with a line from a Morningstar report that literally just dropped early this morning.
Oh, I suspect I know which one.
It's just 6 words, but it basically reframes the entire situation.
Let's hear it.
Quote, wars end. Maintenance contracts do not.
Wow. Yeah, that is the thesis of this entire deep dive right there.
It really is.
That single sentence explains more about the global economy, and specifically the valuation of the defense sector, than 1,000 hours of cable news punditry.
It's just a ruthless piece of economic reality.
Right.
Wars end. Maintenance contracts do not.
Yeah.
So our mission today is to test that thesis. We've got a stack of documents here. We're talking SEC filings, Government Accountability Office reports, and a massive new academic study from Kellogg.
And we're going to break this down into 3 layers for you. First, we'll examine what we're calling the subscription machine.
Right, the hardware.
Exactly.
Hey.
We need to debunk this idea that defense is a cyclical industry. It has effectively become a SaaS business model, software as a service, but, with hardware that lasts 30 years.
And second, we're going to look at the pivot.
This is wild.
It is. This is the part that frankly hasn't been covered enough. The entire AI industry basically rewrote the government contracting rulebook in just 72 hours this week.
The speed of that shift is just unprecedented.
Truly. And finally, the pattern. We'll zoom out to the macro level. We've got historical data on 135 wars over the last 80 years, and it tells us exactly what happens to GDP, inflation, and your personal purchasing power when this machine turns on.
Let's start with that Morningstar quote, though.
Yeah, let's do it.
Because the assumption most investors and voters honestly have is that defense stocks are cyclical.
Right. Conflict flares up, stocks go up.
Peace treaties get signed, stocks go down. It's a boom and bust cycle.
That's the intuitive view. But structurally, you're saying it's outdated.
Completely outdated. If you look at the data from the U.S. Government Accountability Office, the GAO, that view just doesn't hold up anymore.
Because the revenue mix has shifted.
Exactly. The GAO analyzed the life cycle costs of major weapon systems. We're talking fighter jets, missile batteries, naval platforms.
The big ticket items.
Right. And they found that operating and support costs account for roughly 70% of the total price tag.
Wait, 70%?
Mm-hmm.
So the sticker price, the headline number we see in the budget for, buying the jets, that's only 30% of the actual money changing hands.
That's it. For every dollar spent on procurement, actually handing over the keys to the jet, $7 more are spent on the back end over its lifespan.
Over decades.
Over 30 to 40 years. We're talking about maintenance, spare parts, logistics, training, and increasingly proprietary software updates.
Okay, so it's like a smartphone plan.
Exactly like a smartphone plan.
You buy the phone once, right? Maybe it's heavily subsidized. But the carrier is collecting those monthly fees for years.
That's the perfect analogy. Morningstar describes it as an annuity tied to flight hours.
Annuity tied to flight hours. That is wild.
As long as those planes are in the air, the cash register rings. And here's the crucial part. Because these systems are now so software heavy, the government can't just fix them in a garage.
Right. They're locked into the vendor. You can't take your F-35 to a third-party mechanic down the street.
Precisely. Let's look at the SEC filings, the 10Ks, to see what this looks like in practice. Lockheed Martin ended 2025 with a record backlog of $194 billion.
Just to put that in perspective for you listening, that is larger than the GDP of roughly 130 countries.
It is. It's massive. And the F-35 program alone is 26% of their net sales.
Right.
But that mix is actively shifting towards sustainment. So even if the Department of Defense, or the Department of War, as they're officially calling it now, stop buying new jets tomorrow, the revenue from the installed base continues to compound.
Because the jets already flying still need the software patches.
Exactly.
We see this with RTX as well. I'm looking at their numbers right now. Their backlog is approaching $268 billion.
Yeah.
But the really interesting one to me is Northrop Grumman. They're sitting on nearly $96 billion, but their mix is totally different.
Northrop is fascinating because they are heavily leveraged into sensors, command systems, and software.
It's the brain of the operation.
Right. That stuff requires continuous modernization. It's not metal that rusts. It's code that needs patching, security updates, AI integration.
Which is a forever revenue stream.
It is. So the aha moment here is that defense isn't a trade on conflict anymore.
It's an infrastructure play.
Exactly. It's a long-duration, compounding cash flow business.
Which perfectly explains the market behavior we've been tracking. The iShares U.S. Aerospace and Defense ETS is up roughly 35% since last June.
Right, and if investors thought this was just a temporary spike due to geopolitical tension, you wouldn't see that kind of multiple expansion.
They're pricing in the subscription.
They are. The market is betting that the installed base is about to grow significantly, and that base locks in revenue for decades.
And that leads to the real beasting of this first segment.
Yeah.
Because the installed base never really shrinks, right?
Yeah.
We rarely retire systems without replacing them.
Almost never.
So the maintenance bill just accumulates. It compounds on top of itself.
Wars end. Maintenance contracts do not.
There it is again. The liability remains on the balance sheet long after the treaties are signed.
Exactly.
Now, that structural shift in hardware is massive. But I want to pivot to the second layer.
The AI pivot.
Right. Because while the hardware giants are playing a 30-year game, the software world, specifically the AI sector, just condensed a decade of policy into 3 days.
This is the part of the deep dive that's just blowing my mind. Honestly, this specific sequence of events involving the Pentagon and Silicon Valley will be studied in business schools for a very long time.
It really highlights a collision between ethical charters and procurement realities.
Let's set the stage. We're talking about the Department of War, the DoW, and the major AI labs.
Specifically, there was a major breakdown this week between the DoW and Anthropic, the makers of Claude.
Right. And Anthropic has always positioned itself as the safety-first lab. They have a constitutional charter.
Very strict guardrails.
Correct. They were in negotiations for a deployment contract worth roughly $200 million. But according to the SEC filings and reporting this week, Anthropic insisted on strict contractual language.
What kind of language?
They wanted guarantees that their models would not be used for mass surveillance of Americans or for autonomous lethal weaponry without human-in-the-loop oversight.
Which, on the surface, aligns with most public sentiment regarding AI safety right now.
It absolutely does. But in the world of government procurement, rigidity is a deal breaker.
Right.
The DoW operates on any lawful purpose clauses. They need operational flexibility. They cannot have a vendor dictating terms of engagement via a software license.
A software license can't override a general's orders.
Exactly.
So what happened?
The DoW didn't just walk away. They officially designated Anthropic a supply chain risk.
Wow. That is the nuclear option in government contracting.
It really is.
Because that doesn't just kill the $200 million deal.
Uh-huh.
That poisons the well for other prime contractors who might want to use Anthropic's tech, right?
It completely freezes them out. The government basically classified their ethical safeguards as a reliability issue.
Reliability issue. That phrasing is chilling.
But the story gets even more interesting because of how quickly that vacuum was filled. Literally hours later, OpenAI stepped in.
Sam Altman's team announced a deal to supply AI to classified military networks.
Yes. And the nuance here is key for you to understand. It's not that OpenAI doesn't have safety guidelines.
Right, they do.
It's that they approached the procurement process totally differently. Instead of demanding restrictive clauses in the contract that override the DoW's authority, they pointed to their technical safeguards and said, hey, we can meet your needs.
So Anthropic tried to legislate ethics through the legal contract, and OpenAI treated it as a product feature.
Exactly. In high-stakes procurement, the vendor who removes friction wins.
Anthropic introduced friction. OpenAI removed it.
It's really that simple.
And this perfectly aligns with that new directive the DoW issued back in January 2026, the AI First Agenda. I was reading about the Barrier Removal Board.
Oh, yeah, the BRB.
It sounds totally Orwellian, but from a bureaucratic standpoint, it's incredibly effective.
It is. The Barrier Removal Board meets monthly with the specific mandate to strip away procurement obstacles that slow down software deployment.
And their timeline is aggressive.
They are demanding that AI models be deployed within 30 days of release.
30 days. It used to take the Pentagon 30 months just to write the requirements for a toaster.
That's the shift we're seeing in real time. They are moving from a spec-first culture to an adopt-first culture.
Adopt first, figure out the details later.
Right. And the implication is that the rules of how AI interacts with the military, the ethical guardrails, the operational limits, are being set by these procurement economics.
Not by congressional debate.
Exactly.
The speed of the technology has completely outpaced the speed of legislative oversight.
And the money following this is staggering. Jensen Huang, the CEO of NVIDIA, predicted that $3 to $4 trillion will be spent on AI infrastructure by the end of the decade.
3 to 4 trillion.
And the defense sector is aggressively positioning itself to be the primary customer, the anchor tenant for that capacity.
Okay, so let's synthesize this. We have the hardware side, locking in 30-year subscription revenue. And we have the software side, stripping away regulatory friction to deploy immediately.
Yes.
That brings us to the third segment, the pattern, the macroeconomics of all this.
This is where we have to zoom out and look at the wallet impact for you, the listener.
Right, because there's this persistent myth, you hear it in coffee shops, you hear it on cable news, that war is actually good for the economy.
The old World War II narrative.
Exactly, the idea that it jumpstarts manufacturing, lowers unemployment, gets the factories humming.
To test that myth, we are looking at a brilliant 2025 study from the Kellogg School of Management led by Ephraim Ben-Melech.
And this isn't a small sample size.
Not at all. They analyzed 135 wars across 115 countries from 1946 all the way to 2023.
So that covers everything from major geopolitical conflicts to regional civil wars.
Everything.
What does the data actually say?
It completely destroys the myth. On average, war shrinks real GDP by 13%.
13%. I want to pause on that just to give you a benchmark. During the Great Recession in 2008, U.S. GDP dropped by roughly 4 to 5%.
Right.
So we are talking about an economic contraction nearly 3 times worse than the 2008 financial crash.
On average, yes. And the internal breakdown is brutal. Investment collapses by 14%.
Wow.
Household consumption, what you and I buy at the store, drops 11%. But the most critical finding in the Kellogg study is that this applies to the winners as well.
So even if your country wins the war, your economy still loses.
It's a lose-lose situation structurally.
Yeah.
The study is very clear on this. You are destroying capital stock bridges, factories, power grids, and you are diverting labor from productive sectors to destructive ones.
Building things meant to explode instead of building things meant to last.
Exactly.
And then there's the inflation mechanic, because we just established in segment 1 that the government is spending massive amounts on these long-term maintenance contracts and immediate AI infrastructure.
Yep.
But if GDP is shrinking 13%, tax revenue must be falling off a cliff.
It is. The tax base shrinks because the economy is contracting. But defense spending is skyrocketing. That creates a massive deficit gap.
And how does the government fill that gap?
They print it.
They print the money.
They print the money, which leads to persistent structural inflation. And we are actually seeing the markets react to this reality in real time today.
Right, because it's Saturday, the traditional markets like the NYSE are closed. But look at crypto. Crypto has essentially become the first responder for geopolitical price discovery.
And it's flashing red. Bitcoin has been incredibly volatile this weekend. It dropped nearly 4% in a matter of minutes this morning.
That's roughly $128 billion in value wiped out instantly.
And it's telling why it dropped. In theory, crypto is supposed to be digital gold, right? A safe haven during chaos.
The ultimate hedge.
But it's acting like a risk asset. It's selling off because liquidity is drying up.
Yeah.
People are terrified of the exact economic contraction the Kellogg study predicts.
And look at oil. Usually when there is conflict involving major powers, oil prices just skyrocket.
Right, the fear premium.
But JP Morgan is still forecasting $60 a barrel for the 2026 average, despite everything happening this weekend.
That is the anomaly here. We have such a massive structural surplus of energy right now that the fear premium can't overcome the supply glut.
It creates a really weird dynamic.
It does. It means the economy might crash, inflation might spike, but energy somehow stays cheap.
It's a totally unique set of variables.
Yeah.
We have high-tech compounding costs from defense saws, a shrinking GDP forecast, but cheap energy. It's not the 1940s economy, and it's definitely not the 1970s either.
It is entirely uncharted territory. But the historical lesson from the Kellogg study holds firm: the average person becomes poorer.
Yeah.
Thomas Paine actually warned about this back in 1787. He wrote that war's only certainty is increased taxes.
Or in our modern case, increased inflation, which is just a hidden tax on everyone's savings.
Precisely. The Spanish Empire went bankrupt twice in the 1500s due to war debt, despite having literally all the gold in the New World flowing in.
The math eventually wins.
The math always wins.
So let's pull this all together into the receipt for you. We've covered a ton of ground today.
The ledger basically looks like this. Point 1. The defense industry has successfully transitioned to a subscription model,
They aren't selling jets. They are selling 30-year annuities of maintenance and software updates.
which means the costs don't cycle down when peace returns. They compound forever.
Point 2, the AI sector has rapidly reorganized itself around military procurement speed.
The Barrier Removal Board and the shift away from restrictive safety contracts mean the technology is deploying much faster than policy or ethics can keep up.
And point 3, macroeconomic history proves that despite the war boom myth, these events shrank the broader economy by double digits, 13% on average, while driving inflation way up.
Which leaves us with a very uncomfortable question.
What's that?
Well, if the Kellogg study is correct that the economy shrinks, and if the Morningstar thesis is correct that the costs are permanent and compounding, where does the money come from?
Wow. You can't sustain rising subscription costs on a shrinking national income.
You can't. Something has to break. Either the currency devalues significantly to cover the debt, or the subscription model has to face a hard default.
And that right there is why we wanted to do this deep dive today. Not to be alarmist, not to push a political angle, but because understanding this machine is basically a form of financial self-defense.
Exactly. If you don't understand how the invoice is generated, you can't understand why your purchasing power is changing. Economic literacy is the only real shield you have.
Well said. We're going to leave it there for this deep dive. It's a heavy topic, but hopefully the structural mechanics are a lot clearer for you now.
Indeed.
Next time, we're going to look at the other side of this coin. We talked about the hardware and the money today. Next time, we're talking about the information architecture.
Who decides what you are allowed to know in an era of AI-driven warfare?
That discussion is going to be just as critical. Thanks for listening.
Take care, everyone.